In case when the bank is ready to absorb the shock, it's ready to come back in terms of picture, the capital adequacy ratio in terms of the standalone performance will be definitely measured. Assets have to be evaluated and checked across. The assets might not be really performing. They might not be of the standard benchmark altogether. The Reserve Bank will take into account the relevant risk factors of the internal capital that comes into picture. Good morning and welcome to the session 6 of Unit 2 in Management of Banking and Insurance Services. And in this session, we are going to speak about a very important topic called as the Capital Adequacy Framework. Now, in the last session, we were talking about the Capital Adequacy Ratio and its importance to the banking system itself. Now, in this, we are going to talk about why Capital Adequacy Ratio becomes a very important factor. Now, moving forward, let's try to understand first of all what is this capital adequacy ratio. The Basel III norms, actually if I have to start telling you about the Basel, this is one of the biggest convention, a meeting that happened in terms of the banking revolution, the reforms that were brought in global standards altogether. Now what happened here is that the Basel reforms to the response to the Basel Committee on Banking Supervisions and the factor was to improve the banking sector ability to absorb shocks arising from financial and economic stress, whatever the source, thus reducing the risk over the financial security factor or the financial sector as in the whole. Now let me just simplify and give you with an example. 2008 in the United States of America, some of the big names like JP Morgan Chase, Lehman Brothers, or when you talk about those big investment giants like Goldman Sachs or Merrill Lynch, all these companies started facing a severe heat in terms of the financial meltdown. Why did this actually happen? The reason behind it was that you would suddenly see that the financial turmoil coming to you as a surprise, which you are not ready to face, and there is no shock absorber available for you in terms of absorbing the bad loans that are coming into picture. So what the banks tend to do is that as the financial crisis land up on the bank, they have no other option other than taking it as an NPA, as a non-performing asset altogether. At the end of the day, they have to just write down on the book of assets saying that this is not going to be anymore. This is not going to be us anymore. And we are going to lose the money. Now, what happened in the current scenario during the pandemic situation in our country is that in the last 6 months, banks have to lose out a lot of money due to the non-repayment of loans and interest. Now, that factor was very common or very simple that happened all over our system, all over the country altogether. We were not able to go forward. We were not able to absorb the standards altogether. But at some point of time, the banks understood this factor with the Basel III conventions coming into picture. They started understanding this scenario that you need to get yourself prepared for any kind of shocks, any kind of crisis that come across your way. So the Basel III started with this ideology saying that to strengthen the bank level operation, the micro-prudential regulation with intention to raise the resilience of individual banking. Now let me make this word simple for you. If you are running a bank even with one branch or with 100 branches, the aim of the banking sector is to make each and every branch in such a manner with all strength and with all kind of possibility together so that each and every branch is able to perform better day by day. It should not be in a position that the entire bank is dependent on somebody or the bank is dependent on a particular factor altogether. Now, the concept of banking is at the micro level and not at the macro level. It doesn't mean that only the urban branches have to perform and the rural branches will be ignored out of the performance. So what we intend to understand, we intend to create here is that a bank which is stronger right from the root. You need to have the resistance to take it forward and grow in terms of the banking scenario. So that's why we say that whatever might be the reforms, whatever might be the challenges that you are coming across, you need to take it in such a manner that you are able to sail through across any crisis that comes to the branch level banking. Besides, the macro prudential focus also in terms of addressing the wide risk, addressing the challenges that are coming from the digital innovation, that are coming in terms of the financial crisis or a pandemic like this or any kind of disasters that are going to put the financial industry in a backward foot altogether. Now that is going to be always need to be absorbed by the banking industry. So what we are trying to do with the Basel norm altogether is that try to create a sector which is even more stronger in terms of reform, which is even more ready and adaptive enough to face any kind of challenges. So moving forward, we want to see the application of the capital adequacy ratio coming into picture. Now, how does the capital adequacy ratio comes into picture? The consolidated group at level 3 of the capital adequacy ratio requirements, which measures the adequacy of the bank. It says that it's based on the capital strength and the risk profile after consolidating its ability, that is your assets and liabilities put together in terms and joint ventures, associate, except those who are engaged in insurance and non-financial. So let me just go back to the banking sector for a while and make you understand what is this capital adequacy coming factor. The consolidated group, that is group level 3, what I'm trying to talk about, which means the headquarters, the main branch, the head office of a particular bank. Let's say that it is State Bank of India, Canara Bank, or we are going to talk about Punjab National Bank. Whichever bank that is going to come into picture, that bank needs to have a sufficient capital adequacy ratio, and that is going to be measured in terms of combination of your liabilities and assets put together. So you are not going to come into a picture or into a zone where your assets and liabilities are separated, segregated and looked forward. You are rather going to come into a picture, or you are going to come into a scenario where your liabilities and assets are combined and your strength will be profiled accordingly. This condition will not be applicable in the case of an insurance company or an NBFC, which means to say a non-banking financial company. Now moving forward, the standalone, let me use the keyword here called as solo. The standalone or the solo factors that we are talking about in terms of the capital adequacy ratio. Requirements which measure the capital adequacy of the bank based on its standalone capital and risk profile. Now this is very, very important. What is the standalone capacity or the risk-taking ability of the bank? This is highly, highly important. Why? Because when you talk about a banking sector, you need to know that the capital adequacy ratio, which measures the adequacy of the branch, has to be at the single level. Each and every branch should be adequately placed enough based on its own capital. Now, you cannot say that there are certain branches which are performing good, there are certain branches which are not performing good. Now, that will add on to the burden of the main banking system altogether. Now, what we intend to do here is that whenever we look for branches and banks that are located in the urban or in the metro cities altogether, they are definitely performing because they have a reason to saying that our businesses are going forward. Yes, we are able to get better businesses altogether. But an excuse that might be probably given by a rural bank or a tier 2 or a tier 3 banking system altogether will come back and say, sir, we don't have enough business at all. We have been losing and we have been failing badly. Why? Because first of all, the loans are not being recovered, and secondly, we are not finding any new opportunities to grow forward. So what is now coming into picture is that in case when the bank is ready to absorb the shock, it's ready to come back in terms of picture, the capital adequacy ratio in terms of the standalone performance will be definitely measured. You need to understand that very clearly, that unless and until each and every branch of the banking system is ready in terms of absorbing the shock procedures, the shock factors altogether, they will not be able to stand in the capital adequacy factor. So they need to maintain the standards as mentioned, as prescribed by the RBI, followed by the overseas operation of a bank through the branches will be covered in both these scenarios, because this is very, very important for us and interesting. Now, for example, when SBI starts up its operation, let's say in Africa or in UK or in Spain, or let's say it starts up its operation in US, what is the capital adequacy ratio that you have got for that particular branch, for that particular operation in place? Now that is very, very important, and that has to be covered according to the scenarios. So you will not be able to come back and say that the branches outside India are performing at a different level altogether just because they are dealing in terms of dollars, or they are dealing in terms of some other factors altogether. What we are trying to understand here is the operations need to be placed in such a manner. The operation needs to be built up in such a manner altogether. Moving forward, let's talk about the capital adequacy at the group. All banking and other financial subsidiaries, except the subsidiaries engaged in insurance or any other non-financial activities, both regulated and the unregulated factor, what we are talking about, should be fully consolidated for the purpose of capital adequacy. And this is quite fantastic. Why? Because what people tend to do in the banking system is that look into the system as a partition based. Look into certain factors of asset, consolidate it, leave the liabilities alone, then take a standalone position of it. We will not go by this factor anymore. We want a consolidated stand or a position which tells very, very clearly, accurately on this factor that yes, this is the position on which we are standing. This is the factor under which we are doing the banking. So that is why I would always say that that has to be regulated, that has to be understood very, very clearly. Followed by, this would also ensure the assessment of capital adequacy at the group level. A very, very important term which I would like to talk about. Taking into account of the risk profile of assets and liabilities and the consolidated subsidiaries altogether. So when you look into the capital adequacy of the group, we also need to take the account of the risk profile of the assets. What is the risk profile of the assets? Now, a bank might have earned the assets or might taken the assets in terms of giving up the loans altogether. But what is the quality of assets that we are talking about? Now, in the rural sector, there's always a possibility when the assets have to be evaluated and checked across, the assets might not be really performing. They might not be of the standard benchmark altogether. So for the bank, when it goes for a liquidation, for the recovery factor altogether, you might see that the assets and liabilities are not matching at all, and on the other hand, the liabilities will start going up when they are not able to recover the money by selling those assets. So what bank needs to do is a clear risk profiling of the assets, find out the evaluation, find out the quality standard. Are they matching? Can they be recovered at any given point of time? In case of winding up, in case of any scenarios going wrong or going bad altogether, the bank needs to take care of this very, very clearly. They have to take forward and understanding that the quality of their assets are really doing well. Followed by the insurance and the non-financial subsidiaries. Now coming back to the very big sector called as the insurance and non-financial subsidiaries, with the joint ventures and associates of a bank should not be consolidated for the purpose of capital adequacy. Now this is very, very clear. Why? Because let us not jump into this factor at any given point of time. What we are interested is that the equity and the other regulatory capital investments in insurance and non-financial factors, subsidiaries will be deducted first from the consolidated regulatory capital of the group. So you need to first remove all those factors and then start understanding how the system is working altogether. If you're not able to do that, if you're not able to build that system altogether, then there is a problem in terms of maintaining your capital adequacy. So first, let's remove all the risk factors factors, all the liabilities. Clearly, let's write down what are the assets in control and what are the liabilities in control, and then we shall start looking into the capital adequacy ratio. Followed by, now when we talk about this ratio factor at the solo level, we need to understand bank at the solo level, all regulatory adjustments. Now when I talk about it, I'm very, very clear about this factor. All the regulatory levels are required to make, in addition to the investments of the capital group, the subsidiary factors, how they have been taken, whether they are in consolidated position or the consolidated financial statements corresponding to the capital instruments issued by the bank. They also have to be deducted. Why? Because you can understand here that the investments in capital instruments of subsidiaries which are consolidated will have a depreciation, will have their own factors that has to be deducted, will have to be their own wear and tear part altogether. So all those factors have to be deducted, and then let us understand what is the net capital adequacy ratio that you are maintaining. Now followed by the tier 1 or the pillar 1 capital says that the bank needs to maintain a 9% and an ongoing basis. So it might even 10 and 11% is even more attractive. It will be definitely appreciated, but you will not be able to go back at a 5% or 6% or 7%. That's definitely not appreciated from the bank. You need to keep a 9 and plus, which you need to keep going basis on the top end. The Reserve Bank will take into account the relevant risk factors of the internal capital that comes into picture. Why? Because the assessment of each bank is to ensure that the capital held by the bank will commensurate with the overall risk profile. So you need to say what is the risk profile, what are the factors that comes into it, and that's how it will start working in terms of understanding the risk profiling. Now, this would include, among others, the effectiveness of the bank risk management systems, which are very, very important, identifying, assessing, measuring, monitoring, and managing the various risk factors now that are very, very important here. And in terms of understanding the banking book, liquidity risk, concentration risk, and residual risk. So you have to see what are all the various risk factors that have been looked into in terms of the business, in terms of the scenario, and then we have to take it forward in terms of understanding it. So that's how the scenario will grow. The scenario will be understandable in terms of the business. Now, the elements of the common equity tier 1 capital, which means to say that the common shares issued by the bank will meet the criteria. It has to meet as per the factors. Now, the stock surplus that have been coming out in terms of the issue of common shares, what are all the statutory reserves that have been maintained in the bank, the capital reserves, that is also very, very important, rising out from the sale of the proceeds and other factor, because they also come into the picture. Other disclosed free reserve, if there are any disclosed free reserves that have been maintained, that also have to come. The balance in terms of profit and loss previous financial year. So everywhere we will try to account, we will try to make in a factor clear that whatever that is outstanding, that is remaining in terms of the financial capabilities, in terms of the financial factors, the ratios, all the clear-cut ideology that has been told in terms of the reserves, the capital, the outstanding shares, the factors in terms of balance of profit and loss, everything will be accounted in terms of the common equity tier 1 capital. Followed by the elements that are there in the common equity tier. We also talk about the interest-free funds from the head office kept in a separate factor. Now, this is important. Why? Because you might get certain interest-free funds, money that is coming in from the headquarters or from the capital. Statutory reserves kept in the Indian books, very, very mandatory. Remittable surplus. Suppose you have some money which has to be remitted, but then they are in surplus. You have done it. There is some money extra remaining. That has to be taken into picture. The interest-free funds remitted from abroad. In case of property, we know that there is a lot of money coming in from the NRIs and people living in abroad. So that money also have to be kept in a separate account, and we need to account for it, saying that this is the amount of money that has been collected. Followed by capital reserve, representing the surplus that is raising out by the sale of assets. These days you might see that banks get into auction for a lot of capital assets which are not of use for them or which are not been returning any value to them. So all the money that has been raised in terms of the capital reserve assets by the sale of the assets also has to be accounted. The tier 2 capital, which is also very, very important, it talks about the loans and reserves that are being held, and which also talks about the freely available in terms to meet up any loss that is coming up altogether. Now, the next thing is that accordingly, general provisions of the standard asset, the floating factor, that is the floating provision, respects unhedged foreign access, the investment process, whatever the factors in terms of the extra money that has been earned by the bank. It might be in terms of investment, in terms of country exposures, NPA, counter notes that have been get, all those things we keep it as the provisioning buffer altogether, and these factors also need to be accounted. With this, I come to the end of this session. I hope and believe that all the information provided here is of a great help and resource to you. In the upcoming session, we will be talking about a very interesting factor which will govern about the various other factors of banking and the dimensions in terms of making banking as the most happening business in this world. Till then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me on this wonderful session.